I'm going to focus on the real estate that we own directly on Brookfield Corporation's balance sheet. What's unique about our balance sheet is this is forever capital. Our plan is to hold these assets over very long periods of time and continue to focus on improving them, keeping them full, and making them resilient for the future. But what we're seeing on the ground and within our operations is the widest divergence we have ever seen between the performance of high-quality real estate and the rest of the market. Our portfolio, which is comprised primarily of very high quality, in fact, we think the premier portfolio of core real estate that's ever been assembled, is meaningfully outperforming the market. Our real estate investments today is about $24 billion. About 60% of that is invested in our premier core portfolio. These are the best of the best. The performance of these 29 assets has been exceptional over the last 12 months in the face of a challenging real estate market. So despite what you've read about, net operating income in this portfolio is up 6% year over year. The portfolio is virtually full and it's leased on a long-term basis, and we're conservatively financed. And this is a really important part of our investment strategy with real estate, is this is a cyclical business. These are illiquid assets. We need to be able to hold them through good times and bad. And so what that means is our financing strategy on each of these assets is asset level, non-recourse financing on each individual property. So how did we grow NOI by 6% in such a challenging market? It's really a combination of three things. Number one has been strong occupancy gains. Our leases are about 12% below market. And so there's a natural mark to market as leases renew on an annual basis. Our debt maturity profile is a well-laddered portfolio. We have about 15% of our debt coming due in any given year. And so what that means is there's no wall of maturities. There is a huge difference between office product like this that is fit for purpose, that's desirable, that companies want to locate in, and the traditional commodity office space that is becoming functionally obsolete. So the other half of our core portfolio is comprised of 19 best-in-class shopping centers here in the United States. We've seen a dramatic turnaround in the demand for this very high-quality shopping space. As we sit today, net operating income this year is up 10% year over year. The portfolio is conservatively financed, but importantly, we're full. It's 97% occupied, and most of these centers have waiting lists of tenants waiting to get in. These are all very large-scale assets, many of them in excess of $1 billion, and are some of the highest productivity retail centers anywhere in the world, with average tenant sales over $1,100 a square foot. Our transitional and development business is naturally liquidating as we pursue a buy, fix, and sell strategy. And the plan going forward is to dedicate capital for those types of new investments in the future through our asset management franchise. The fundamentals and tenant demand for high quality real estate with a proven manager like ourselves continue to be in high demand. And with rate increases now largely behind us, we see the opportunity to continue to generate compelling returns on our real estate for Brookfield.